How do you transform 21 acres of industrial land into a vibrant urban community that seamlessly blends commercial, life sciences, and residential spaces? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Today we're diving into a fascinating development project in South Boston that's captured the attention of the commercial real estate world. The project, known as On the Dot, is a visionary fusion of commercial and residential development that aims to redefine urban living in a rapidly changing environment. The Boston Real Estate Times reports that this 21-acre master plan development is set to become Boston's next premier life sciences hub and walkable residential district. Located between Southampton Street, the Amtrak rail yards, and Dorchester Avenue, On the Dot is being developed by Core Investments, with Sterling Bay as a key development partner. The site, formerly used for industrial purposes, will be transformed into a mixed-use neighborhood featuring 12 new structures, including approximately 1,365 residential units and over 2 million square feet of commercial and innovation space. The development is structured to unfold in 4 major phases, with the first phase focusing on residential complexes and public realm enhancements. Subsequent phases will introduce life sciences and office buildings, along with retail spaces. The project is noteworthy for its commitment to sustainability, with plans for all-electric buildings and green infrastructure, including over 200 trees and bioswales. On the Dot also emphasizes community impact, promising significant affordable housing options and allocating 20% of its retail space to affordable, locally owned small businesses. The development team is investing in job creation and workforce training alongside substantial transportation infrastructure improvements. The project's strategic location in South Boston offers excellent connectivity, being just minutes from downtown and the Andrew MBTA Red Line station. The realignment of the street grid, including a new D Street extension, aims to improve urban circulation and integrate the neighborhood with surrounding areas. While the full cost of On the Dot has not been disclosed, the scale suggests a multi-billion-dollar investment. The financing will likely come from private equity, institutional real estate capital, and potential public-private partnerships. This ambitious project not only aims to transform the physical landscape, but also embodies a forward-thinking approach to urban development, focusing on equitable growth, climate resiliency, and neighborhood vitality. Stay tuned as we continue to explore more groundbreaking projects in commercial real estate. In a notable transaction, an office building near the Denver Tech Center has been acquired by Shea Properties for $12 million, according to a report by Cassidy Ritter in the Denver Business Journal. This price is significantly lower than its previous sale nearly 2 decades ago when it was an active office property. The building, located at 4,340 South Monaco Street, spans 124,000 square feet, and has been vacant for the past 6 years. Shea Properties plans to convert this 4-story building into a 143-unit affordable housing development. The property last exchanged hands in 2006 for $69.3 million, a sale that included a nearby office building at 4,350 South Monaco Street. With the recent acquisition, Shea Properties also secured the first right of refusal to purchase the neighboring building. The company submitted preliminary plans to the City of Denver in March 2024, aiming to rezone the property and secure necessary funding for its conversion into apartment units. In August, the Denver City Council rezoned the property, paving the way for its transformation into a planned unit development. The council also approved up to $29 million in Colorado multifamily housing revenue bonds to support the project. The apartment units will be income restricted, targeting tenants earning between 30% and 70% of the area median income. Construction on this adaptive reuse project is slated to begin soon and is expected to take about a year to complete. This move by Shea Properties aligns with a broader trend in Denver, where developers are converting vacant office spaces into residential properties. Recently, the Luzzatto Company acquired 2 office towers in downtown Denver from E2M Ventures, which they plan to convert into over 700 multifamily units. This project, spanning 973,000 square feet across 621 and 633 17th Street, is set to become one of the largest office-to-residential conversion projects in the country. The Great Lakes Mall in Mentor, Ohio, is potentially heading to the market, as reported by Dan Shingler. The mall's owner, Washington Prime Group, has been dealing with financial challenges, leading to the sale of its remaining properties, including the Great Lakes Mall. This move follows the company's Chapter 11 bankruptcy filing after the COVID-19 pandemic severely impacted retail centers. The firm has been liquidating assets, selling nearly $1 billion in properties over the past 2 years, according to CoStar's National Director of United States Retail Analytics, Brandon Sveck. Local real estate experts suggest that the mall might be repurposed into a light industrial center, similar to the successful conversion of Akron's Chapel Hill Mall. The demand for industrial space in Northeast Ohio remains tight, with vacancies in the single digits, making such a conversion likely. Alternatively, the mall could be transformed into residential developments, as seen in other parts of the country. Chris Salata from the real estate fund management firm PREP has indicated that Northeast Ohio has seen several malls repurposed into light industrial or residential spaces. Given the market conditions, Salata anticipates that Great Lakes Mall might follow a similar path. Ed Matsoulis from Colliers also predicts a possible conversion into industrial use, noting that the mall's large size could accommodate multiple users. George Pofok of Cresco Real Estate highlighted the advantage of having a large block of space with a single owner, which simplifies redevelopment processes. Additionally, the vast parking areas typical of malls could be repurposed or developed further. Mentor's supportive municipal environment is also seen as a favorable factor for redevelopment. Mentor City Manager Ken Filipiak suggests that while a mixed-use development is likely, retail might still play a role in the site's future. The city aims to maintain a component of retail to support the local economy, but is open to multifamily residential options. However, warehousing and distribution are less favored due to their limited economic contribution to the community. Industrious, a prominent co-working firm, has signed a lease at the new Alto office building in East Austin, marking its latest expansion in the city. The lease covers 21,660 square feet at 924 East 7th Street and positions Industrious as the first tenant in the newly completed building. This move pushes Industrious's local footprint to approximately 200,000 square feet, a significant increase from the 125,000 square feet reported in May 2024, when the company operated across 4 offices in Austin. The Alto building, co-developed by Aquila Commercial and institutional investors advised by J.P. Morgan Asset Management, reached substantial completion in March. Industrious's new location will feature 251 seats and is slated to open in May. This expansion adds to Industrious's presence, which includes 4 offices in downtown Austin and 2 along Burnett Road, at Victory Plaza and 7001 Burnett. Industrious was the second largest co-working firm in Austin last year, trailing behind WeWork, which reported about 398,000 square feet. The new lease at Alto helps Industrious close the gap with WeWork. The ongoing growth of co-working spaces in Austin reflects a broader trend in commercial real estate, where companies are increasingly seeking flexible office solutions as employees return to in-person work environments. Earlier this year, CBRE Group Incorporated announced plans to purchase the 60% stake in Industrious that it does not already own, valuing the co-working firm at approximately $800 million. This acquisition underscores CBRE's commitment to the shared office market, aligning with the growing demand for flexible workspace solutions. The Alto building still has 77,345 square feet of office space available for lease, along with 6,646 square feet designated for retail and restaurant uses. The triple net rental rates for the remaining office spaces are set at $46.50 per square foot. 2 suites, measuring 8,787 and 10,677 square feet, are being developed on a speculative basis, with completion expected in the second quarter of 2025. These suites could potentially be leased as a single unit, offering a combined 19,464 square feet of office space. Located just a block from Interstate 35, the Alto building provides convenient access to downtown Austin, Muller, Rainey Street, and the University of Texas campus, making it an attractive location for businesses looking to establish a presence in East Austin. In this week's roundup of commercial real estate news, we delve into the challenges and opportunities facing the industry. According to a report by Kyung-Sun Song in Insurance Insider, the commercial property sector is experiencing a period of softening amidst broader macroeconomic uncertainty. This trend is reflective of shifting market dynamics and changing investor sentiment as businesses navigate the complexities of the current economic landscape. The report highlights that despite a decrease in the Consumer Price Index in March, the commercial real estate market is not immune to the ripple effects of macroeconomic shifts. The announcement of new tariffs by former President Donald Trump earlier this month has further complicated the outlook for commercial property investors. This uncertainty underscores the importance of strategic planning and risk management in maintaining stability and ensuring growth in the sector. As commercial property owners and investors face these challenges, there are still opportunities for growth and innovation. The report suggests that those who are able to adapt to the changing landscape, leverage market intelligence, and strategically position their portfolios will be well positioned to capitalize on emerging trends. The focus on sustainability, technology integration, and community engagement continues to shape the future of commercial real estate. In conclusion, while the commercial property market is experiencing a period of softening, the potential for growth remains. By staying informed and agile, industry players can navigate the complexities of the current economic environment and uncover new opportunities. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.